trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels, and it's that time again for Coach's Corner, and we've got kind of a personal one here, Stu.
Yeah, we
We were speaking to some traders yesterday,
Yes,
and I kind of forgot what the topic was, but you asked a question, a related question, and said, why can't this option fall below intrinsic value? And what did we get for an answer?
crickets.
We got crickets. Not only nobody even took a shot at it, which normally we have people at least throw in jokes, comments, whatever. We got nothing. And we kept prompting them, giving them hints. We said, this is something that you got to know. It will help you to understand strategies, but it can also just be good to understand markets, because sometimes people say, but what if the market makers, or what if the market is bidding below intrinsic value? And you're going, that's just not going to happen. You need to understand why that's the mechanics behind that. So that's what we wanted to talk about today. So good stuff. Let's start off with our chalk talk question. Let's say the stock is 105. We have a a 30-day $100 call trading for $4. Now, what's the intrinsic value here?
Looks like
$5. There should be $5 of intrinsic value. Why is that? We have the right to pay 100, and the stock is at 105. How could we buy the right to pay 100 for only $4, right? So if we add those together, if we add the strike and the current call price 104, that should, it seems come up to at least 105. And that's really the dilemma that we were asking people. How is it that this cannot happen? So the first question here, is there a mispricing? Should be pretty obvious. But now, more importantly, how would you capitalize on it? What would you do if you actually saw this in the market? Or if you wouldn't do it, what do you suppose that somebody else would do? How would they fix that?
Yeah, that's what I was really kind of going for. Like,
Yeah,
recognizing it and then,
right.
okay, now what? What does it mean?
Yep.
What's off? How can we take advantage of it? And I was kind of shocked that we were just getting crickets on
Just
it. I mean, it
nothing.
told me that there was a complete lack of understanding of what intrinsic value is versus the value of the underlying asset.
Yeah, and
And that's a problem.
why it has to be there. Okay, so that's going to be our topic here. Why can't options trade below intrinsic value? Now, we should probably put a little caveat here, Stu. Sometimes near expiration with the bid, especially if you get in volatile stocks, it can. But what we're really primarily talking about is why can't you buy an option below intrinsic value? It's never you're never going to see it on the offer. So that's really the question. Why is this not a possibility? All right. So We want you to kind of think about that for a moment, jot down some answers, and then we'll answer it at the end of the presentation. So before we get started, as always, please remember marketrebellion.com, right there on your screen, /get started. We have all kinds of articles, tutorials, videos to help you get started. Topics very much like this that will help you make better decisions. So check us out there, all free, of course. So let's
Bill,
start with the first.
you want
What's
to hear
that?
want to hear a funny story?
Let's hear it.
So I'm thinking, I cracked myself up. I'm thinking of this many years ago. We were trading on the floor and we had this stock, and I can't remember the name. Doesn't really matter. But we're looking at the 14 calls.
Okay.
The strike was 14. It was expiration day, and we had, this is prior to dual listing. It was a single list, so we were the only game in town. So there was a seller. Somebody was long a lot of calls. There was a seller of the calls,
Mm-hmm.
and we made the market. It was a 14 calls. The stock was 15 bid. So we made the market one bid, which was parity.
Yep.
And the guy comes in and sells them. Well, we all turn around, sell the stock at 15. All right, great. We have this synthetic put for 0. All right, cool. So now we make them. This is when we traded in ace. Now we
Yep.
make them 7 ace and 8.
Okay.
And don't you know he sells them at 7 ace?
Hmm.
And they're
Interesting.
15, and the stock's 15 bids still.
Yep.
So we're like, okay, now we have the synthetic put for credit to us. So now we make them $0.75. So they're offered at parity to the bid on the stock.
Okay.
Well, he sells them at 3/4, and we're all kind
Unreal.
of looking at each other thinking like, this is crazy, right? Like, where's everybody? Why is this? Well, that's what was going on. So we kind of upped our game a little bit. Here's what we did. We made them 5 ace, 7 ace. So they were actually offered under parity.
Right.
And
Interesting.
and we got a call from one of our regional brokers who we did business with.
I can
He said,
imagine.
what are you guys doing? This looks really bad. Because we were trying to like promote business, so it looked, from a marketing standpoint, it just looked really bad. So we kind of told the guy the story. Well, we said fix them. So we did. We made them 3/4, 1 and an eighth, 3/4
Okay.
$1. Somebody came in and paid $1 for 5 or something. We made them 7 eighths and eighth, and that was it. But yeah, these things can happen.
They can.
These days, because it's a multiple listing landscape, and because there's such a robotic interest, in the marketplace, it tends to not happen. It's not going to happen. There's too much competition. There's too much money
And now with the
looking at
algo bots, right? Right.
so they're going to come in and they're going to kind of fix it. But the point of the story was that, back in the day, it could have happened. But these days, if you don't really get this whole idea of, what is intrinsic value, like what is it?
Right.
And what does it represent? And put together the idea that it represents something relative to something else, which is the underlying, the value of the underlying, the value of the right, and the value of the actual right to do something with the asset. Putting those together seemed to create this void in our conversation the other day.
Yeah.
And that's why we're doing this.
Yep. Cool story. So let's take a look at an example of intrinsic and extrinsic. I think most people know that, but some may not. Let's put our stock at 105 and say that the $100 call is trading for 6. Now, in this example, we have $5 of intrinsic value. And that's just saying, again, the way you figure that out is we have the right to pay 100 for stock that's worth 105. All right, so now some people give you a formula and say it's the stock minus the strike, assuming it's a positive number, can't be negative. So we'd say 5 minus 100, but that really doesn't give you the reasons why. I like to just say you've got the right to pay 100 when the asset's worth 105. Well, that should be worth at least $5.
It just makes sense that it needs to be worth $5.
Right. And it seems that if it's not, that something's off, and that's really where we're heading. What is this something that's off, and how would the market correct for it? But we also
John, I think we lost Bill.
sorry about that. So we have I don't know where I cut out. So we have this that's trading for 6. We have $5 of intrinsic value. So we can account for 5, but the option's trading for 6. So this extra dollar is extrinsic value. So that would be the intrinsic and the extrinsic, or the time value. And this extrinsic value is what decays. So if the stock stays at exactly 105 between now and expiration, we're only going to lose $1. Now, sometimes traders misinterpret this and say, oh, does that mean that this is a high water mark and this option can't lose 5 or even the full 6? No, not at all. It's just that in order to lose the 5, we need the stock to move against us.
Right. Again, it kind of shows the same thing. It shows a lack of understanding of
Right.
exactly what that intrinsic value represents.
Right. There's 2 different ways to lose this money. This is just from the passage of time and or the stock moving against you. And this is strictly from the stock moving against you.
Or for you, actually, if it goes up, you'll lose extrinsic
Well,
value.
yes, that's true. But I'm just saying if this were to go to 0, it would be
Yeah.
moving against you. But yeah, that could also be going to 0 if the stock moved for us.
Right.
Yep, very good. Start
That
moving
extrinsic
towards-
value, side note, will eventually always go to 0.
Yep, trading at parity. So now the question is, what would make, or would it, is it ever possible for this call to trade below the intrinsic value? So here we've got it trading for 6. We know it's got to trade, or at least it seems like it should trade for at least 5. Again, just logically, we've got the right to pay 100 when it's worth 105. It seems that it should be worth at least 5. So our question is, could it trade for less than 5? That would be trading below intrinsic value
Below parity.
or below parity. So the question is, can this happen? So we're going to answer that and say no. But now the question is, why? How would the market correct for this? And what's the answer here?
Competition.
Competition, but mostly arbitrage. Yep.
Right. People are going to be scrambling to collect the ARB
Oh,
until
for
the
sure.
ARB is no
Free
longer
money.
there, creating a fair value trade. And and then when that happens, it's like, oh, what do I care about a fair value trade?
Yeah. There's enough competition on the floor or even among traders just to go out and buy and sell calls or stock, right? We know how crazy, we've all seen pictures of trading floors or trading places. It can be chaotic, but those aren't even certain. But imagine if you dropped $100,000 in Central Park. What do you think is going to happen? It's going to be a madhouse, right? It's everybody scrambling because there's no risk in it. You got to just pick it up. And that's what an ARB is, or an arbitrage. So you want to throw something that's going to throw chaos down there. You let something like this happen.
Can I call up somebody in Central Park and say, save me the last 100?
Save me the, yeah, not going to, by the time you pick up that phone, it's gone.
It's like, I want to sell the last 100 shares.
Same thing here. That's going to, if it does happen, as Stu said, it could, it's just not going to last long.
Highly
Especially,
unlikely.
especially in today's market. Do not spend your time saying, well, let me pick some stocks and see if I can find some. That's going to be a waste of time. Computer's going to pick it off long before you see it.
Here's a little side note as well. So let's say you buy that call at 6, like Bill was saying, with the stock at 105, and you just kind of hang out, right? And now the stock actually goes your way. And now the stock's trading at 110. So the value of the stock at this point is 110. How do we know that? Because that's where it's trading. We paid 6. The current value of the call has to be at least 10 plus interest in any extrinsic value,
Right.
which is called 0 interest and no extrinsic value. It's say it's expiration. So let's just say it's 10. You paid 6. It's still going to be trading at fair value.
Yep.
But from your P&L standpoint, it's $4 under your parity.
Right.
And you could go ahead and lock that gain in.
Yep.
That intrinsic value gain, by simply shorting the stock against the call.
Yep. So that's
Same
what we're
thing
going
with
to talk about here.
the
One of
put, you
one of the
know.
ways.
Go
What's it?
ahead. I was
So
just
what?
going to
That's
say, you can do the same thing with the put on the stock, except you're not selling the stock like you do with the call. You buy the stock.
yeah. We're going to do that in a second. We got slides for that. So let's start off with the arbitrage. What is that? What does it mean? So there's really two conditions. Now, sometimes you'll hear people define an arbitrage is that it's a guaranteed profit. And that's really missing the point that if we have the reason you can't use that as an arb is because what if you're using a risk-free asset like a treasury bill? Well, that's a guaranteed profit. The problem with that definition or with a T-bill being an arb is that you have to spend your own money. You have to part with it for some time, and that's part of what is an investment. It's a risk-free investment, but that's not an arb. The arb is even better than a guaranteed profit. It also includes the second condition for no cash outlay. So in other words, it's self-financing. And that's why it's truly free money. You don't need your own money to do it. So if we go back to the T-bill, it's as if this setup creates enough money for you to buy the T-bill and then profit from the gains in there. I mean, it's just too good to be true, which is why these don't come along all that often. Now, another question we get from people, should arbitrage be illegal?
So
I've heard
hold on
people say that these are like the vultures of the markets and that this is
one
just
second. One second. Let's
deplorable.
go back. Let's go back to the cash outlay for a second.
Okay,
So you might be wondering, like, what do you mean? I gotta own the call, which means I gotta buy the call. How could there be no cash outlay?
right.
So as we often speak about in our Q&As and our sessions, you're not thinking deep enough.
That's
You
right.
got to go to the next level, right? Yeah, you have to buy the call, and that costs money. But the trade is selling
Self-financing.
stock against it, and when you sell something, you're going to receive cash, and that's why you don't have to lay out any real money. You're selling
Correct.
something, you're getting money for the stock, you're buying the call. It's actually a huge credit, and the value of it is what the value of the difference is what creates the art.
Yep. So it's kind of funny that the arbitrage is always about a relative difference between different assets. You can't arb just a call. It would have to be a call against something else. And actually, the word arbitrage comes from, I think it's the French arbitraire, some derivative like that. And what it really means is to judge, like the word arbitration. And that's really what you're doing, but you have to have two different assets to judge. So we have a guaranteed profit for no cash outlay. Don't forget that second condition. A lot of people leave that off and say that an arb is just guaranteed profit. That's misunderstanding it. So let's go back to this other question now. Should it be illegal? Are these guys vultures? Are they doing something deplorable? Is this like insider trading? Well, what do you think?
I think people that are trying to do that are actually creating a fair and orderly market. I think
That's
we should
exactly
have
right.
people
They're
trying to.
creating a very important economic function because what it does, it means that it's fair for the rest of us.
Yeah.
They're
See,
creating the
but put
market.
yourself on the other side of the trade. If
That's
you
right.
own that call and you're trying to sell it, and the arb wasn't in place,
Yeah, you could be
you
getting
might sell
totally
it.
hosed.
Yeah, you'll get totally. Yeah, you might sell it for $1 under parity or $2 under
That's
parity.
right.
But the advent of creating the arb, um, with competition puts people in the game, and you'll actually get a better price.
That's right. So yeah, there are some people that do that, but you can look at it as compensation for that job. Somebody's got to go and search for it and find it and get these prices back to where they should be. So no, it's nothing illegal. It's not like some kind of a shadow market. It's just today it's going to be done with computers. So again, makes prices fair for the entire market. So let's continue on here. And before we do, slides are not advancing. There we go. Quick reminder, marketrebellion.com/get started for more topics just like this, articles and videos, all for free. Speaking of ARBs, there you go.
Great.
So let's take a look at the arbitrage for calls. How would this be carried out? So let's go back and say that the stock is 105 and we see the $100 call trading for 4. Now, as we showed before, the intrinsic value should be $5. And the way you figure that out is to, again, don't memorize formulas. Say, I've got the right to pay 100 that the stock's worth 105. So there's $5 right there. But I've got to buy the call. So if I can buy the call for less than 5, that would be a screaming good deal. So this should be a setup for an ARB. So how are we going to do this? Well, as Stu said, the ARB is not just this number by itself. It's this against this. That's what you're judging or comparing are these two values. So what we're going to do is we're going to short the stock and we get 105 credit. Whenever you short a stock, you sell it just as if you owned it. In fact, the market makers, the traders, nobody is the wiser. They just know it's a sale. Now, just the fact that you borrowed it, the fact that you borrowed it from the broker and owe 100 shares is really irrelevant. It's just a sale of stock.
Yeah.
So you've got this 105 credit just as if you own the shares. Yes, you do have this 100 shares that you owe, but it doesn't change the fact that you've got this credit. Now what are we going to do? Now we're going to spend $4. Now where do we get the $4 from, Stu?
Well, we got to pay for the call. We got to sell the stock, so we get it from the $105.
We got this nice big fat credit there.
Yeah, check please, $105. Take it.
That's where that's coming from. So now our net credit after we buy the call is 101, and you should be able to put the pieces together now and say, hey, I can exercise the call and pay 100, and that'll clear out my short position. Remember, if we've got 100 shares that we owe, and if I exercise that call and spend 100, but I've got 101 cash, that's a guaranteed profit. No matter what happens, the stock can rise, fall, sit still, it does not matter. As soon as you short those shares for 105, it's done. Because remember, you don't even have to exercise immediately. We're going to talk about that, but you could even wait till the next morning, next week. The real trick is getting the sale off. And now we've got this guaranteed profit. So this becomes our risk graph. All right, as soon as we short those shares, that's where those negative deltas are coming from. But the purchase of the call is flattening out over this way. And you can see that the entire curve, this black line, sits above 0. That green box is sitting at +1. And so now we're locked in. All we have to do is exercise the call, and we're going to capture that free dollar. However, Stu, there's something we like to teach our traders. What would we typically tell people to do instead of exercising right away?
Hold it. Have the synthetic put.
You might as well. Yeah, take a look.
I would never exercise it. Look, your account may not, the dollars in your account, maybe the margin, all that, won't allow you to hold on to the call and the stock at the same time. But
possible.
If at all possible, definitely.
Hold it. This is called an expiration graph for that reason. It's not going to go below. But if the stock does fall below, let's say it's at 95, well, instead of exercising the call and paying 100, forget the call, pay 95. Now you've got an extra $5. Now your ARB profit is $6. Now it's not really part of an ARB profit because we had to speculate that or get lucky that the stock fell. We're guaranteed the dollar, but we might make more. So that's why we tell traders, just hold on to it. Treat it like a lottery ticket. Yeah. If the stock sits still, if it doesn't fall, even if it spikes up here to 115, fine, exercise at 100. Can always grab the dollar.
That call, if it's trading the way it is, it's $100 call, and every, penny for penny, it's going to move with the stock. Nothing lost on the upside.
Right.
Whatever you lose as the stock's going up on the short sale, you're going to be making on the call. So it's a zero penny game. On the downside, though, you do have that free put, and I've seen it happen.
Oh, I have too. Absolutely. Yeah, you might as well. Anytime you can get a position for free that might make more money and there's no cost to it, I mean, why? Why not? We've done this in our service where if we split, we'll split vertical spreads apart.
Yeah, we will.
Because the long position has no bid. Well, why would we close it for 0? Doesn't matter how far out of the money it is. It could always happen. So it makes no sense to close a long position for nothing. And kind of the same thing here. There's no sense in closing this ARB out when you've got this free put hanging out here.
And by the way, completely off topic here. Anybody who's listening to this, who trades short iron,
yep.
Think about what we're talking about here. You got an out of the money put spread, where the long is that you short, where the long is like no bid.
It
You think
happens,
you can't unwind it because there's no bid, you can't
right?
sell the long, just buy back the short.
Buy back to short.
Just buy back the
Yeah.
short, hold on to it, put it in your back pocket, you never know.
That's one of the few times where a market order will not fill
Same thing
because
with
they'll
the
say
call,
there's
the out of money call.
yeah, they'll
Yeah,
say there's no bid on it and they'll just reject the order. Well,
yeah,
it's a good thing. You don't want to sell it for nothing anyway.
right.
Yeah. So anyway, this is kind of a cool visual here of the ARB. This is the way that it'd be more from algobots these days. But way back in the day, especially when the SIBO was first getting started, they used to have ARB desks where people were paid to just sit around and look at stocks and say, hey, you know what? Here's kind of an ARB, just because they were that inefficient. But nowadays, don't expect it to happen. But again, the good news is the prices are fair for the rest of us. But now, Stu, what's going to make this come back into line? We said that $4 is too cheap. We can see that the ARB profit is exactly the amount of the missing value, right? We said this should be trading for 5. It's trading for 4, so it's $1 short, and that just happens to be the amount of the profit, and that will always be true. So what's happening here with these transactions? Well, as people come in here and start hammering the stock to short it, what happens to this price? Starts coming down. And as people start buying the call to lock that in, what happens to this price? Starts going up. And eventually they're going to meet. So it's not like this just stays at 105 and this works its way from 4 to 5. They're going to meet somewhere in the middle. So maybe the stock goes to, drops to 104 or to 104 and a half, and the call gets bid up to 4.5. But something's going to happen where the stock is dropping, the option's going up, and it restores that intrinsic value. That's the point to see, that the arbitrage is its own undoing. That's why it can't last forever. It's good while it lasts, but then the ATM eventually runs out of cash quickly. Okay, so does everybody see that? Look at the position. Shorting the stock is going to knock that price down, and buying the call is going to push that price up. And eventually they're going to meet somewhere in the middle there to where you can't arb it anymore. All gone. So that's one for calls. Where else can we use this? Kind of this little trick. Maybe not for seeing a discrepancy in prices, but what about after hours news? Let's say that the stock goes up in after hours. Not that we've ever seen that, right? Happens all the time. And so how could you capture the gains? We just had some people in our Q&As talking about this on several stocks. Oh, it went up 20, 30 points in after hours. I can't wait to close it on the opening bell. Well, the opening bell, it might be gone.
Might be.
Stock might come all the way back. So
And
if you really want to capture it, what can you do? Well, there's no options market. Well, what do? Short the stock and then exercise the call, or just hang on to it for the free put.
you're selling it's hard to see for people because the markets are closed, stores
Yeah.
closed.
Yeah.
It doesn't mean that the value of your call is what you're looking at on your screen.
No,
The value of your call is relative to the value of the stock.
of the stock. That's right.
It represents the right to do something with the buy or sell the stock. Buy it if it's a call. So you gotta think outside the box, and
Yeah.
you gotta think that the value of the call now is, we'll just call it parity, which is not what you're looking at. But what you're looking at, the store's closed and it's not updated. If you had the keys to the SIBO and you said open the store for a minute, all the markets, would come into,
Yeah.
you'd see it. But that's not really the case. So you have to be able to see the value
That's right.
of the intrinsic value of that option, and then trade against it to capture and lock in those gains.
Right. So let's just do a quick example. I probably should have created a slide, but let's say we're back to our $100 call and the stock is trading at 120, maybe after an earnings announcement.
Yeah.
And you're going, oh boy, this call is going to be worth $20. I paid $4. It's going to be worth $20 tomorrow morning on the opening bell, assuming the stock is still 120. Well, that's a big assumption. Again, we've seen many times where it's trading up in after hours and down on the morning bell. So if you really wanted to capture it for 20, what do? Just short the stock. It's really the same steps as the arbitrage. It's just that you already own the call. See, in the previous step, we had to short the stock and then buy the call. Here, you already own the call. So you're just doing the second half of that, and you're saying, okay, the stock's at 120, short the stock at 120. Is there any rush to exercise it? Nope. You could do it that night. You could do it next morning, whatever. Just do it before it expires and exercise that call, and now you've locked in the $20.
Or you can actually never exercise it and just let expiration exercise and
And that is true
get rid of
too.
the short stock and it just goes away.
And just goes away. Yep. So there's lots of things, but part of what we also like to show is that there's a lot of moving parts in the options market, and this is why a lot of people get trapped or don't fully understand strategies. And you have to be able to look at this and say, well, I can tell that there's some missing value in here. So that's something you can do if you have a call option for after hours. Now let's look at the ARB for puts. So let's say that our stock is 105, and now we're going to look at the 110 put that's trading for 4. What are we going to do here? First of all, is there some missing intrinsic value? Don't memorize formulas. Say I have the right to sell for 110 when the stock's at 105. Well, is that an advantage to sell for 110? Yeah. How big is the advantage? $5. There's your intrinsic value. But now we look and say, hey, hang on a second, Stu. There's not $5 of intrinsic value. It seems like it should be at least 5, but it's not even, we're not even holding intrinsic value. What do we do here? Now, I know you mentioned it before. Here, we're going to actually buy the stock. So we spend 105. We buy the 110 put. We spend 4. So we have a net debit of 109. Now, I know a lot of people say, hey, wait a minute. I thought you said no cash outlay. Well, I mean, this doesn't even leave your account. Because the very second you do this, you exercise the put and collect 110. So it's not like it really ever incurred any kind of opportunity cost or interest cost. They're just steps to buy the stock, buy the put, and then exercise. And so now, if we've spent 109 and we exercise and get our 110 strike, what's the difference? Our profit of $1. Where did that $1 come from? That was exactly the amount that was missing off of the intrinsic value. So those are some steps that all of you out there in YouTube can do. Just try different scenarios and say, well, what if the put we're trading for 3 or for 2? And if you say, okay, if it's trading for 2, it's $3 below, then when you go through the ARB, you should end up with $3 here. Just good practice. So if we do that, what do we get here? We're long the stock and we're long the put. We get a synthetic call at bend of 110. That's the same as the strike. So what do we do now? You could exercise it and close it, like we talked about here. But what else can you do? Hang on for the ride, right? You're not going to lose. You're guaranteed. You've locked in. We can see the very lowest point of this black line is at +1. So you're never going to fall. That's your high water mark. And so we know for sure that's not going to get taken away, but we have these deltas out here. We now have the ability to make some money. Might as well just hold on for the ride. So any closing comments with that, Stu? That was fun.
There's a lot of applications to this.
Yeah.
I mentioned one or two of them with the short irons. You just got to recognize, one of the problems that I see in the coaching sphere is that people have this inability to look down the road and come up with a scenario on the stock price at some future date.
Yep.
And put together, well, what'll be the value of my option?
Yeah.
And we get tons of these questions like, "Oh, show me how to use the option calculator," and it shows that there's a lack of understanding about what intrinsic. It kind of starts with that. It's gotta have a value, and the value, if it's in the money, it's going to have a value. of the difference between the stock price and the strike price. It's just,
Correct.
it's the right to, on the call, it's the right to pay 100 and the value of to pay 100 for the stock, and the stock is actually trading at 110. So there's got to be $10 in there. And, when you can kind of recognize that, you could say, well, if the stock's 120, what will it be? Well, you know that the extrinsic value will be a little lower, and depending on what the time and the volatility and all that, kind of fun stuff. But you start to get in the game about like what's going to be the price of my option.
Yeah.
And then once you can kind of see the future, not the future of where the stock is going to be, I'd like to be able to see that, but the future of where the option or
Will
where
be.
the strategy can
That's correct.
be, as you outline lots of different scenarios in the
That's right.
stock and in time and in interest rate fluctuation and in implied volatility
Volatility. Yep.
movements, right? Kind of putting them all together. Now you're where you should be. But there seems to be a lack of connectivity between putting together like this is my strategy and this is where the stock is going to be. So what's it going to look like? Well, I have no idea. Let the markets open and it'll I'll see. Now,
Yeah.
now you're behind the eight ball.
Now you're
But
behind.
now it's like, oh, I just got my what kicked,
Yeah.
or oh, I made all this money, but you don't really have an idea
Yeah.
of like why
You had the opportunity and you didn't recognize it. Right.
you didn't recognize it. You think you're a superstar, and you don't realize that you really just got lucky. And then
Yeah.
you do it again, and you win until you just get obliterated one day, and all of a sudden your account goes from 150 grand to 25 grand. And you're like, oh my god, what happened?
Only so
So
long you can last on luck, for
yeah,
sure. And that's what we want to make sure that everybody understands some of the finer points about option. And that's what we're going to be talking about in Miami next week. I know a lot of our people are going to be down there. So for any of you, I think they're out of tickets though, but you could probably call and check. But if not, keep in touch for future events. I think we're going to have a lot of these going on, but very intensive trainings just like this. So let's go ahead and finish out for our question for today. Why can't options trade below intrinsic value? Arbitrage. That is your answer right there. So, stock is 105, 30-day $100 call. Is there a mispricing? Yes. How would you capitalize on it? What do y'all think? Short the stock, exercise the call.
or just buy it.
Yep, and that's going to do it. So anyway, those are some things that will help you to understand why that intrinsic value has to be there in a market. And if for some reason it's not going to last long. Fractions of a second. I mean, I don't think I've really ever seen it. You'll see it on the bid once in a while, but you'll never see it on the offer.
Right.
Yeah. So anyway, that's it for our Coach's Corner. We hope that you again picked up some useful information. That's what it's all about. Pick up this toolbox of all of these different ideas. And when you start collecting a lot of information, lots of knowledge, that's when you're going to make your best decisions. And that's going to lead to better trades. So I hope you picked that up some good stuff, and we'll see you next week on Coach's Corner. We'll see you then.
You will. See ya.